United States Federal Reserve has decided to hold interest rates unchanged at 4.25 to 4.5%. In its statement, the Federal Open Market Committee, FOMC, concluded that risks of higher unemployment and inflation have risen and inflation remains elevated. The statement also said that uncertainty about the economic outlook has increased further. Hello and welcome to Global Business Insights, where we look closer at headlines moving markets to equip viewers with perspectives to help them thrive in today's business environment. In Nigeria, there was some progress in tax reform as the Nigeria Revenue Services Bill and the Nigeria Tax Administration Bill have been considered for third reading and passed by the Senate. The other two of the four tax reform bills, that is the Nigeria Tax Bill and the Joint Revenue Board Bill, are slated for passage later today. Google's stock sank over 6% yesterday after Apple revealed that it is adding artificial intelligence search engines such as Perplexity to its default Safari web browser. This came out during Google parent Alphabet's antitrust trial. Last year, a federal judge ruled that Google maintained an illegal monopoly through its search business. During the trial, it was also revealed that Google pays Apple $20 billion a year to use its search engine as the default search option in Safari. Media giant Disney exceeded expectations in its most recent quarter, bolstered by an unexpected boost in its Disney Plus streaming business and strong results from its theme parks that suggested consumer resilience despite a turbulent global economic environment. The domestic parks and experience operating income was up 13%, while Disney Plus gained 1.4 million users, taking the total to 126 million. Disney also announced that it is planning a new theme park in Abu Dhabi. Uber reported first quarter gross bookings up 18% of $42.8 billion, but less than estimates of $43.1 billion. Uber's closely watched outlook was better than expected, with gross bookings for the second quarter expected to be in a range of $45.75 billion to $47.25 billion, and analysts were initially expecting $45.85 billion. So there is a bit of an upside in terms of the bookings expectations, which of course is a delight to analysts. A federal appeals court yesterday rejected a legal challenge by the U.S. Federal Trade Commission to Microsoft's $69 billion purchase of Call of Duty maker Activision Blizzard. The San Francisco-based 9th U.S. Circuit Court of Appeals upheld a lower judge's order that said the FTC was not entitled to a preliminary injunction blocking the deal, which closed in 2023. Nvidia stock jumped late yesterday, closing up 3.1% in yesterday's session after it was reported that the administration could relax export curbs on artificial intelligence chips. Other chip stocks also rallied after the report that Trump could overturn AI chip export curbs that were put in place by the Biden administration that were set to go into effect. The S&P 500 was higher in choppy trading as markets digested comments from the Federal Reserve signaling that the risks for an economic slowdown and higher prices are increasing, while sentiment was also boosted by optimism that the US and China will begin formal negotiations on trade tariffs over the weekend. Ghana's consumer price inflation has slowed for a fourth month in a row in April to 21.2% year-on-year from 22.4% in March. The Statistics Office announced that the latest decline was mainly due to a moderation in both food and non-food inflation. Guinea has initiated a process to revoke Emirates Global Aluminium's mining license. Emirates Global Aluminium, equally owned by Abu Dhabi Sovereign Wealth Fund, Mubadala, and Dubai Sovereign Wealth Fund, the Investment Corporation of Dubai, operates one of the largest bauxite mines in Guinea through its Guinea Alumina Corporation subsidiary. As fiscal space tightens for many African countries, the move reflects a wider trend of resource-rich African nations seeking to exert greater control and getting more revenue and value for their mineral wealth by reviewing terms, a development that is reshaping the global mining sector. It is expected that the Bank of England at their Monetary Policy Committee meeting later today will cut rates by 25 basis points. But back to the US Fed decision, where the administration would like to see more dovishness, but with the Fed maintaining its patient approach, despite repeated calls from the president for it to cut borrowing costs, also labeling Powell as Mr. Too Late. We close with clips from the press conference led by the chairman, U.S. Federal Reserve Board, Jerome Powell.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer-run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Asia-Pacific markets traded mixed after the U.S. Federal Reserve expectedly held rates unchanged. Also, oil prices stabilizing as lingering uncertainty over the outcome of trade talks between the U.S. and China, the world's 2 largest oil consumers, weighed on sentiment. Brent crude futures were unchanged at $61.12 a barrel in early trade, as investors seek clues on what could be the outcome of the upcoming trade talks this weekend in Geneva. Later today, the Fed Reserve Bank of New York releases its survey of consumer expectations for April. Markets are closely monitoring developments on trade deals, especially as the White House has called a press conference later today, teasing a major trade deal announcement with a big and highly respected country, adding that it would be the first of many, but provided no further details. Media reports are speculating that Britain is set to sign a trade deal with the US, making it perhaps one of the first few countries to do so after stiff reciprocal tariffs were announced and paused. Well, that's all on this special edition of Global Business Insights. Thanks for watching. This is Bode Oshosami. Bye-bye.